How much is Tesla actually worth now and in the future? You see, the way we used to evaluate companies using traditional methods are outdated. There are many kinds of evaluation metrics like price to earnings ratio, price to book, free cash flow, dividend yield, and etc. Basically, value investing. Value investing is made popular by Warren Buffett, and he is the most successful investor now. The mere mention of his name, people worship his methods, and I pretty much agree. Copy what works. I'm also a value investor. I love value investing. Value investing essentially is buying something at a discount. That's it. If the stock is cheaper than its intrinsic value, it's probably a no-brainer to buy, as it will make you money in the future from selling it. However, things don't remain the same over time. Nothing ever does. If we had applied traditional value investing metrics to the current market situations, we would have missed out on a lot of good stocks. Warren Buffett had a super late entry into Apple. He could have earned so much more. Warren Buffett also missed out on stocks like Google, Amazon, Netflix, Facebook, etc. These companies are worth over $1 trillion, making up most of the Standard & Poor's index and other US stock indexes. So if these evaluation metrics are outdated, what is the matrix you can apply and historically not miss out on stocks like Google, Facebook, Alibaba, Amazon, Netflix, etc.? You see, there's one thing in common for such companies. During the earlier years before they exploded in value, they were constantly spending lots of money to grow. Wherever they earn or any cash raised through the capital markets, they will spend it on infrastructure to exponentially grow the company, and this will result in pretty shitty profits. Traditional value investing methods will not work here. Taking a look at Amazon earnings per share, you realize back in 2005, this company is not earning a lot of money. You see, the earnings per share is pretty bad and sometimes it's negative. And you realize that in 2016 it started to explode upwards when Amazon starts to take a lot of profit. Let's take a look at Facebook annual earnings per share. Back in 2007 when they just got listed, you look at the earnings per share, it's pretty crappy, almost no money earned or sometimes losing money. But however, starting from 2015 onwards, it started to take off drastically. So every year is like increasing 80%. During these years over here, the initial years, these companies were spending a lot of money on infrastructure. So they were spending all the money they could raise to expand the company really fast. There's a pattern to these companies. These companies generate massive amount of revenue while growing consistently. Revenue meaning total money coming in from sales without deducting anything. For example, a cafe sells $1 per cup of coffee and they sell 10,000 cups of coffee per month. The revenue is 10,000. During the initial years, after deducting expenses into expanding the company exponentially, the company is usually making little or no profits. This makes the company's finances look pretty bad, thus the shitty profitability. The way we evaluate such companies should be a matrix called price to sales ratio. It essentially means taking the market capitalization, which is the total value of the company, and divide by revenue. I'll explain this simply. If a company generates $10 billion worth of sales and is worth $10 billion, isn't it very cheap? And if a company generates $10 billion worth of sales but is worth $100 billion, doesn't it sound overpriced? Yes, this is a very simple matrix, but it has mostly worked historically. What you are looking for are companies that has a low price to sales ratio. The benchmark is 2. Anything below 2 is a good ratio. If you were to Google price to sales ratio and you scroll down, in this website called Investopedia, somebody asked what is considered a favorable price to sales ratio. So ratios generally between 1 and 2 is considered good, and anything below 1 is like a gem. Let's take a look at some companies. You'll notice these companies are either fairly priced or overpriced. If you take a look at price to sales ratio of major tech companies, let's look at Google. Google's price to sales ratio is 5.5. If you look at Amazon, it's 3.9. Netflix 7 now. Facebook is 8, Microsoft is 8, Uber is 4, Disney is 4, Apple is 4. So as you can see over here, a roughly fairly priced company is around a price to sales ratio of 4. Something which is really expensive is about 8. At one point in time, Facebook price to sales ratio was about 13. So again, I summarize, a fair price to sales ratio is around 4 for a technological company. To find the price to sales ratio of a company, you need to go to finviz.com, and on the top left over here, you key the ticker symbol of the company you want to see the price to sales ratio of. For example, Apple, I'll just key the symbol AAPL, and I need to scroll down. So the price to sales ratio of Apple is 4.06. If I want to find Facebook, so I just need to key FB, which is the ticker symbol for Facebook. I click on the search result, and the price to sales ratio of Facebook is 8.16. This is how you find the price to sales ratio of listed companies in the US. So now let's come to the topic on Tesla and how I evaluate Tesla. I estimate Tesla's revenue for 2019 will be 25 billion. We are just a few months away. Having a fair price to sales ratio of 4 for a tech company, Tesla should be minimally worth $100 billion in the current market, and that translates to roughly $600 per share in the current market. So with so much growth ahead, let's look at the year 2024. This is a chart where I came up with spending hours of research, and it's a conservative estimate, and I'll show you how I came up with the numbers. On the left column here, we have US deliveries. This means the cars coming out of USA. On the middle column here, we have China deliveries, means these cars are coming out of Gigafactory 3 China in Shanghai. Over here, this is German deliveries. According to inside sources, the next European Gigafactory will be in Germany. So for now, I take that inside source as a very high probability and putting it in Germany. And this is the numbers I estimate. So now 2019, these are the numbers, and every year after that, I actually have a 30% increase. So that means to say I'm already discounted Elon Musk by a massive 20%. So these are very conservative numbers. And now let's go to China. Shanghai's Gigafactory will be up in like 2 weeks time. In year 2020, I estimate that Shanghai Gigafactory 3 will produce 150,000 cars, which is what Tesla is reporting, but I'm a little bit more conservative. And because it's China, I'm going to have a 40% growth each year. So every year I multiply by 1.4. And now moving to German deliveries, Gigafactory will be up and they'll be producing 100,000 cars and they'll have annual 50% growth. To summarize this chart, it's a conservative projection at a 20% discounted growth. And what happens is that Tesla will roughly deliver 2.3 million cars in 2024. And that translates to roughly 110 billion revenue. So if you apply a price to sales ratio to the revenue of 110 billion, it comes up to about 1,320 for a price to sales ratio of 2. If it's a price to sales ratio of 4, which is fairly priced, the stock should be at $2,640 per share. And sometimes the market can overprice stock, just like Google is overpriced at 5.5, Facebook is overpriced at 8, Microsoft is overpriced at 8. So let's say if Tesla is overpriced at 8, it should be worth $5,000 per share. This matrix I share here can only be used on newer companies and not old established companies, because if it's used for old established companies and the price to sales ratio dropped so much, probably the company is in trouble right now, just like the oil companies. Considering the growth and potential and having the Albert Einstein of the 21st century, Elon Musk, running the company, the risk to reward ratios are looking pretty good right now. I hope you learned a lot from this video, and probably this is one of the very best ways you can find the next Amazon, Google and Facebook. If you like the kind of content I produce for such video and you want to get the latest update on that notification bell, good. Bye.